Warren Buffett has done this before, exactly this, and when he did it last time, the financial system collapsed within 18 months. Here is what is happening right now. Berkshire Hathaway, the company Buffett spent 60 years building, is sitting on $373 billion in cash, not invested, not deployed, sitting in treasuries, waiting. And Berkshire has been a net seller of stocks for 13 consecutive quarters. That is more than 3 years of selling, quietly, methodically, relentlessly, while Wall Street spent those same 3 years celebrating a bull market. The last time Buffett built a cash fortress like this, the 2008 financial crisis followed. Not a correction, not a pullback, a collapse that wiped 57% off the S&P 500 and triggered the most destructive deleveraging event since the Great Depression. Most people are treating this as old news. They have heard about the cash pile. They shrug and move on. That is the mistake, because here is what they are missing. This is not just about the size of the pile. It is about the pattern. In 2006 and 2007, in the 2 years before Lehman Brothers fell, Berkshire's cash position as a percentage of total assets reached levels that had only been seen once before. And that previous peak was right before the dot-com bubble burst in 2000. 2 peaks, 2 crashes. Each time, the crash arrived within 18 to 24 months of the peak. The Berkshire cash ratio just hit a new all-time record in 2025, and nobody is connecting those dots. Think about this from your own situation for a second. You have a 401k, you have savings, maybe a mortgage. And the man who has spent 6 decades studying financial cycles, who has survived the dot-com crash, the 2008 collapse, the COVID shock, and every major dislocation in between, is not buying anything. He is converting everything he can into cash and government paper, not because he panicked, because he sees something. There is one other data point that ties all of this together. The Buffett Indicator, the ratio of total US stock market value to GDP, just hit 228%. To put that in context, before the 2008 crash, it was at 109%. Before the dot-com crash, it was at 146%. Today, it is at 228%, the highest reading in recorded history. Every prior peak in this indicator was followed by a major market correction, every single one. And yet, the financial media is calm. Your broker is calm. The talking heads on television are calm. Warren Buffett is not calm. He just won't say it out loud. In this video, I am going to show you exactly what Buffett did in 2006 and 2007, the specific sequence of moves, and then show you that the same sequence is playing out right now in 2026, almost step for step. I am going to show you where Ray Dalio's framework places us in the long-term debt cycle. And I am going to show you what this means for your money specifically, your savings, your retirement account, your cost of living in the next 12 to 18 months. If this is the kind of analysis you have been looking for, subscribe to the Reid Briefing. I publish this every week, and this week it matters more than most. Stay with me, because what comes next is the part nobody wants to say out loud. To understand what Buffett is signaling, you need to understand the framework Ray Dalio has spent 50 years building. Most people think of the economy as something that grows, occasionally dips, and then grows again, a line that trends upward with some noise. That is not what the economy is. What Dalio's framework, the economic machine, shows us is that the economy is a collection of overlapping cycles, each one layered on top of the last. Each one with a beginning, a middle, and an end that has repeated throughout history with remarkable consistency. There are 2 cycles that matter right now. The short-term debt cycle runs 5 to 8 years. It is the standard recession and recovery pattern most people recognize. The Federal Reserve tightens credit, the economy slows, the Fed loosens credit, the economy recovers. Most analysts live inside this cycle. It is all they watch. It is why most of them are going to be wrong about what is coming. The second cycle is the one Buffett understands, and the one Dalio has been warning about for years, the long-term debt cycle. It runs 50 to 75 years. It ends not with a recession, but with a deleveraging, a systemic unwind of debt accumulated across generations. And the critical thing to understand is this. By the time the long-term cycle turns, no amount of short-term intervention can stop it. The Federal Reserve can cut rates, Congress can spend, the Treasury can borrow, but none of those tools reverse the long-term cycle. They slow it, they redistribute the pain, sometimes they delay it by years. They do not cancel it. Here is where the United States sits right now. Total U.S. national debt has crossed $36 trillion. Annual interest payments on that debt have exceeded $1 trillion, surpassing the entire U.S. defense budget for the first time in modern history. Dalio's framework has a specific name for this stage, Phase 5, the point in the long-term debt cycle where debt service costs begin to crowd out everything else, where the system can no longer grow its way out of the problem, where the only remaining tools are inflation, currency devaluation, or restructuring. Now here is the historical parallel, and I want you to pay close attention to this. In 1918, after World War I, Britain emerged as the world's dominant empire, but carrying war debts that consumed a staggering portion of government revenue. British economists at the time said the debt was manageable, controllable. They pointed to the pound's status as the world's reserve currency as a permanent stabilizer. What happened? Over the next 38 years, through a Second World War, through Bretton Woods in 1944, through the Suez Crisis in 1956, the British Empire systematically lost its financial dominance, not through invasion, through the mathematics of compounding debt and eroding currency confidence. The pattern Britain entered in 1918 and the pattern America entered in 2009, when post-crisis stimulus moved the debt problem from private balance sheets onto the governments, are structurally identical. Here is the question I want you to sit with. If the pattern is the same, does the timeline compress or extend in a world with modern central banks and digital capital flows? That answer changes everything about the next 18 months, and I am going to get to it. But first, you need to understand the specific historical blueprint, because one empire went through this before America did in a way that maps almost perfectly to today. And what happened to ordinary citizens at this exact stage of that empire's cycle is the part most financial channels never explain. If this depth of analysis is what you are looking for, make sure you are subscribed to the Reid Briefing. This is exactly what we do here. The British Empire, that is the parallel. And before you dismiss it, hear the specific sequence. Because the sequence is what matters, not the size of the empire, not the era, the sequence. In 1918, Britain emerged from World War I as the world's dominant military and financial power. The pound sterling was the global reserve currency. British banks financed global trade. London was the center of the financial world. By almost every surface measure, Britain looked unassailable. But underneath the surface, three things had happened that could not be undone. Britain had borrowed massively to finance the war, its manufacturing base had been redirected and then disrupted, and its debt-to-GDP ratio had crossed a threshold that left government finances permanently constrained. Sound familiar? Stage 1 was denial. British economists and politicians pointed to imperial strength as proof the debt was manageable. The pound would hold, trade would recover, the system would grow its way out. This lasted through the 1920s. The public felt it in rising costs and stagnant wages. The establishment kept insisting on recovery. Stage 2 was the first crack, the 1931 sterling crisis. Britain was forced off the gold standard, the monetary anchor it had maintained for over a century. What the establishment had called impossible happened in a matter of weeks. The pound devalued. Capital began moving. Stage 3 was the shift that sealed it. Bretton Woods, 1944, the conference that formally transferred reserve currency status from the British pound to the US dollar. Britain was still standing, still had an empire, but the financial architecture of the world had already moved on. The institutional investors, the equivalent of Berkshire Hathaway in 1944, had repositioned years before Bretton Woods was signed. Stage 4 was the public confirmation. The Suez Crisis, 1956. The moment the world visibly saw that America, not Britain, held real financial leverage. The empire did not fall in battle. It fell when the United States withdrew financial support and Britain could not sustain the operation without it. Within 3 years, the dismantling of the British Empire accelerated beyond reversal. Now, here is where the pattern gets uncomfortable. America's Stage 1, denial, ran from 2009 through approximately 2022. Post-crisis stimulus, record low rates, the dollar is safe consensus. Stage 2, the first crack, arrived in 2022 through 2024. Inflation that the Fed insisted was transitory. Rate hikes that cracked regional banks. A bond market that began, quietly, to question the math. Stage 3, the institutional repositioning, is happening right now, in 2025 and 2026, before any public confirmation event, before the Suez moment. And here is the rhetorical question I want you to genuinely sit with. At what stage of Britain's cycle did the smart money actually move? It was not after Suez in 1956. It was not after Sterling crisis in 1931. It was before, years before. The institutional repositioning always precedes the public confirmation by a significant margin. Warren Buffett sold $134 billion in equities in 2024 alone. He is not repositioning after the Suez moment, he is repositioning before it. What happened to ordinary British citizens at this exact stage, Stage 3, was not dramatic. It was quiet. It was erosion. Savings that bought less each year. Borrowing that cost more. Job markets that shifted in ways that felt inexplicable until they were obvious in hindsight. That is the part one need to show you with today's data. Because this is where the historical pattern connects directly to your 401k, your mortgage rate, and your grocery bill right now. Give this video a like if the historical parallel is landing. It genuinely helps this analysis reach more people. And stay with me, because the next section is where the current data confirms everything. Here is the data point that should have been front page news this week, and was not. The World Gold Council's March 2026 Central Bank Survey reveals that 68% of the world's central banks now plan to increase their gold holdings this year, up from 62% in 2025. Not individual investors, not hedge funds, central banks, the institutions that manage the financial reserves of sovereign nations. More than 2/3 of them are moving away from dollars and into gold, simultaneously, right now. Think about that for a second. When one central bank moves to gold, that is portfolio management. When 68% of them move to gold at the same time, that is a verdict on the dollar system itself. Here is the second signal. The People's Bank of China added 25 tons of gold in February 2026 alone, bringing its total to 2,257 tons. China has been buying steadily and deliberately for 3 years. They are not buying because gold has performed well. They are buying because they are constructing a reserve system that does not require holding US Treasuries. That distinction matters enormously, and most people are completely missing it. Here is the third signal, and this is where the pattern gets serious. China has slashed its treasury holdings to $730.7 billion, the lowest level since December 2008. The last time Chinese treasury holdings were this low was the year Lehman Brothers collapsed. They are selling American debt and buying gold simultaneously. That is not a coincidence. That is a strategic repositioning executed over years that the mainstream financial press has barely discussed. Now layer this against what Berkshire is doing. Berkshire Hathaway remained a net seller of equities for the 13th straight quarter through the end of 2025, with sales outpacing purchases by billions of dollars. 13 quarters, more than 3 full years of selling. And the strategy has continued under the new CEO, Greg Abel. This is not a Buffett quirk. It is institutional conviction embedded deep enough to survive a leadership transition. What does Dalio's framework tell us about a moment when the world's most disciplined value investor is selling equities, while the world's largest sovereign institutions are selling dollar-denominated debt, while central banks globally are rotating into gold at a rate not seen in modern financial history? It tells us this is not multiple separate stories. It is one story. It is the institutional layer of the global financial system pricing in the late stages of the long-term debt cycle quietly, methodically, and far ahead of any public acknowledgement. The Buffett Indicator, total U.S. market capitalization divided by GDP, currently reads 232.6%. That is the highest level ever recorded, 2.05 standard deviations above its long-term trend. Before the dot-com crash, it hit 146%. Before the 2008 collapse, it hit 109%. It is now more than double its pre-2008 peak, and Wall Street is describing this as a valuation concern, not a crisis signal. Here is what the data is actually showing us. The institutions that move first in every major financial transition are already positioned. Berkshire, the People's Bank of China, the central banks of Poland, India, Uzbekistan. They do not announce what they are doing. They act. The announcement, if it ever comes, arrives years later when everyone can already see it. And this is where it stops being an economics lecture and starts being about your money specifically. Here is what the decision makers are actually thinking and why it matters more than anything you have heard so far. The surface story on Buffett is valuation. Markets are expensive. Berkshire is being patient. Cash earns 4% in treasuries, smart capital management. That is the story most analysts are telling. And it is not wrong. It is just not the real story. Here is the real story. 3 separate data points, each individually explainable, converge into a single insight that almost nobody is stating directly. Data point 1. The dollar's share of global reserves has fallen to 57.74%, a 2-decade low. And official gold holdings worldwide now stand at $3.909 trillion, nearly matching the $3.920 trillion held in US Treasury securities by central banks globally. Read that again. The world's central banks now hold almost as much in gold as they hold in American government debt. That has never happened before in the post-Bretton Woods era. It is not a trend, it is an inflection point. Data point 2. JP Morgan's own research quantifies the mechanism precisely. Each 1 percentage point decline in foreign treasury holdings relative to GDP, approximately $300 billion in treasuries, pushes U.S. yields higher by more than 33 basis points. And foreign central banks have been reducing treasury exposure consistently for 15 years. The math is not complicated. Less foreign demand for U.S. debt means higher borrowing costs for the U.S. government. Higher borrowing costs on $36 trillion in existing debt means the interest payment, already above $1 trillion annually, compounds upward. And that compounding crowds out every other government priority. Data point 3. Between 2022 and 2024, Berkshire sold a net $172.93 billion in equities. In 2024 alone, the company sold a net $134.1 billion in stocks, parked almost entirely in short-term U.S. Treasuries, earning risk-free returns while waiting. Now here is where these 3 points converge into one unified insight, and this is the part most financial channels never say out loud. Buffett is not just preparing for a market correction, he is preparing for a paradigm shift. Dalio's framework has a specific name for this. A paradigm shift is when the dominant investment logic of an era reverses. The logic of the last 40 years was straightforward. U.S. equities outperform. The dollar strengthens over time. American debt is the world's safest asset. Hold U.S. stocks. Hold U.S. bonds. Win. What Ray Dalio's framework tells us about this exact moment is that paradigm shifts do not announce themselves. They are only visible in hindsight, except to the institutions that are already positioned for the next paradigm before the old one ends. The central banks buying gold are not reacting to a crisis. They are pre-positioning for a world where dollar-denominated assets carry a risk premium they did not previously carry. And the institution sitting on $373 billion in cash and short-term treasuries, earning yield while staying liquid, is holding exactly the asset that survives the transition period between paradigms. We are living inside this part, not the crash, not the recovery, the transition, the window between the old paradigm still appearing to work and the moment it visibly stops working. Think about your own position for a second. You are probably still holding a portfolio built for the old paradigm. US equity index funds, maybe some bonds. A 401k weighted toward American stocks because that is what has worked for 4 decades. That positioning made complete sense in the world that existed between 1982 and 2022. The question Dalio's framework forces you to ask is whether that same positioning makes sense in the world being built right now, quietly, by the institutions that move first. I want to know what you think. Drop a comment below. Do you believe we are in a beautiful deleveraging or an ugly one? Tell me, because that question has a very specific answer in the data, and I am going to give it to you in the prediction section. But the other side tells a different story, and I want to give it a fair hearing before I tell you why I think it breaks down. The counter-argument begins with Buffett himself, because Buffett, the man this entire analysis is built around, has repeatedly and explicitly stated that he is not timing the market. In his final annual letter to Berkshire shareholders before stepping down, he reaffirmed that Berkshire would forever deploy a substantial majority of its capital in American equities. He was not sounding an alarm. He was describing discipline. The cash pile, the optimists argue, reflects a shortage of attractive opportunities at Berkshire's scale, not a strategic retreat from American capitalism. When you manage $373 billion, the number of deals large enough to move the needle is genuinely small. That is not pessimism. That is arithmetic. The second counterargument is the one that carries real intellectual weight. The dollar has no credible replacement, and it probably will not have one for decades. The euro is structurally fragmented. The Chinese yuan is not freely convertible. No alternative reserve currency has the depth of market, the legal infrastructure, or the institutional trust that the dollar has accumulated over 80 years. The dollar's share of global reserves has declined. That part is true. But declining from 70% to 57% over 25 years is not a collapse. It is a gradual rebalancing in a more multipolar world. The dollar remains, by an enormous margin, the dominant settlement currency for global trade, the pricing mechanism for oil and commodities, and the safe haven asset that every major institution reaches for in a crisis. That structural position does not evaporate because central banks are buying gold on the margin. The third counter-argument addresses the debt cycle directly. The United States has carried unsustainable-looking debt before. After World War II, U.S. debt to GDP exceeded 120%, there's higher than today. The economy did not collapse. It grew rapidly. Technological innovation, demographic expansion, and rising productivity allowed America to outgrow its debt burden without the painful deleveraging Dalio's framework predicts. The optimistic case argues that artificial intelligence represents precisely that kind of productivity leap, one that could structurally shift America's growth trajectory in ways that the historical debt cycle framework cannot fully price. And fourth, the Federal Reserve has demonstrated twice in the last 20 years that it will intervene with unlimited force when the system is genuinely threatened. In 2008, it did what was previously considered impossible. In 2020, it did it again, faster and at greater scale. The Fed is not a passive observer of debt cycle dynamics. It is an active participant with tools that historical empires simply did not have. These are serious arguments. I am not dismissing them. But here is the precise single flaw that runs through all four blocks, and it is the same flaw in each case. Every one of these counter-arguments assumes the current system's credibility remains intact. They assume foreign creditors keep lending. They assume the dollar's reserve status absorbs whatever fiscal pressure America applies to it. They assume the Fed's interventions continue to land without triggering the inflation they are designed to suppress. And in 2006 and 2007, the last time these arguments were made confidently, they were also technically correct, right up until they weren't. Dalio's long-term research shows that debt crises often migrate from the private sector to the public sector. After 2008's mortgage-driven crash, he argues, the leverage problem moved onto government balance sheets through stimulus and deficit spending. The optimistic case requires that migration to stop or reverse not without a disruptive adjustment. What the data actually shows is that the migration has continued, accelerated even. The debt moved from banks to government, the government kept spending, and the interest bill kept compounding. And that gap between what the optimistic case requires to be true and what the balance sheets actually show is exactly why the next section matters. So let us stop talking about empires and debt cycles for a moment and talk about what this means for your money specifically. Because everything covered in this video so far, the Buffett cash position, the central bank gold buying, the dollar's declining share of global reserves, the Phase 5 debt cycle dynamic, each one of those forces has a direct transmission mechanism into your daily financial life, not eventually. Now, let me show you exactly how. Start with your credit card. Americans are carrying $1.28 trillion in total credit card debt as of Q4 2025, the highest balance since the New York Fed began tracking this data in 1999. The average APR on cards currently accruing interest stands at 21.52%. That is not a rate on a luxury purchase. Roughly 55% of credit card balances exist to cover essentials, groceries, rent, healthcare, not discretionary spending. The debt cycle does not stay abstract. It shows up as interest on your grocery bill. A $7,000 balance at 21% costs you nearly $1,500 a year in interest on money you already spent on things that no longer exist. That is the debt cycle touching your kitchen table directly. Now, your savings. You have probably noticed that your savings account rate has quietly declined even while inflation remains stubborn. Here's the mechanism. The Federal Reserve opted not to cut rates at its first two 2026 meetings in January and March, and is expected to hold again in April and May. But banks pass rate cuts to savers faster than they pass rate hikes. The squeeze moves in one direction. In the 1970s stagflation, the closest historical parallel to the current debt cycle stage, the purchasing power of a $50,000 savings account dropped by 40% in real terms over 7 years. Not because the number changed, because everything that money could buy cost 40% more. If the current cycle follows even a partial version of that arc, the question is not whether your savings are growing. It is whether they are keeping pace with what you actually need to buy. Now, your retirement account. Here is what most people are not calculating. The Buffett Indicator, total U.S. market cap divided by GDP, currently stands at 232.6%, the highest ever recorded. Before the 2008 crash, it stood at 109%. Before the dot-com crash, it was 146%. Your 401k, if it is weighted toward a standard U.S. equity index fund, is exposed to a market priced at more than double the valuation that preceded the last two major crashes. Dalio's all-weather portfolio framework exists precisely for this stage, identifying asset classes that historically absorb capital when equity valuations revert toward the mean. Commodities, inflation-linked bonds, gold, not as speculation, as structural balance in a portfolio during a late-cycle debt environment. Now, your mortgage and borrowing costs. Delinquencies of any duration increased to 4.8% of all outstanding household debt, the highest rate since the third quarter of 2017. The rise in mortgage delinquencies is not evenly distributed. Borrowers in the lowest income quartile have reported the sharpest increase. If you are trying to buy a home right now, the combination of still elevated mortgage rates and historically high prices has compressed affordability to a degree not seen since the early 1980s. And if rates rise further, because foreign demand for US Treasuries continues declining, because the Fed cannot cut without reigniting inflation, the ceiling on what you can borrow gets lower even as the price of what you want to buy stays high. You have probably noticed this already, even if you did not have the framework to explain it. Things cost more than they should. Borrowing is harder than it used to be. Your paycheck buys less than it did 3 years ago. That is not bad luck. That is the late stage of the long-term debt cycle transmitting itself into lived experience. The institutional layer repositioned first, the data layer confirmed it second, and the personal financial layer, Where you actually live is where it arrives last and lands hardest. If this kind of specific pattern-based financial analysis is what you are looking for, subscribe to the Reid Briefing. This is exactly what we do here every single week. No noise, no sensationalism, just the pattern and what it means for you. So here is where this goes. And I am going to be direct because that is the point of this channel. Short term, the next 30 to 60 days. The Federal Reserve holds rates again at its May meeting. Inflation data remains sticky above the 2% target, partially driven by energy costs that the geopolitical environment is not going to resolve quickly. The market interprets the hold as neutral. Equities drift sideways or post modest gains on any positive data release. Nothing dramatic happens, and that is precisely the danger. The absence of a visible crisis in the short term is not evidence that the structural problem has been resolved. It is evidence that we are still in the transition period, the window between institutional repositioning and public confirmation. Buffett's cash pile sits. The central banks keep accumulating gold. The Buffett Indicator stays above 228%. The surface looks calm. The architecture underneath does not change. Mid-term, the next 6 to 18 months. This is where the two paths split clearly, and I want to name them directly. Scenario 1, the managed compression. The Federal Reserve engineers a soft landing with surgical precision. It cuts rates twice in the second half of 2026, just enough to ease credit stress without reigniting inflation. Foreign Treasury demand stabilizes. The dollar weakens gradually, but not catastrophically. Equity markets correct 15 to 20%, totsy, painful but orderly. The long-term debt cycle continues its slow grind rather than accelerating into a disruptive deleveraging. Berkshire deploys a portion of its cash into distressed quality assets. Dalio calls it a bumpy but manageable transition. Ordinary Americans feel it as a prolonged squeeze. Higher costs, tighter credit, slower wage growth, but not a collapse. Scenario 2, the cascading trigger. A single event, a failed treasury auction, a sovereign credit downgrade, a currency crisis in a dollar-dependent emerging market, or an unexpected spike in unemployment breaks the surface calm. Foreign creditors reduce treasury exposure faster than the Fed can absorb. Long-term yields spike, mortgage markets seize, equity markets reprice toward historical valuation norms, which, from 232% on the Buffett Indicator, implies a correction that is not 20%. It is 40 to 50%. The beautiful deleveraging Dalio describes becomes the ugly one, not because anyone planned it that way, because the math finally demanded it. Based on every historical parallel in the last 300 years of debt cycle data, the more probable path is a version of Scenario 2 arriving through the mechanism of Scenario 1. What I mean by that is this. The attempt at managed compression is real and genuine, but the debt cycle does not respect intention. It responds to mathematics. And the mathematics of $36 trillion in debt, $1 trillion in annual interest, a Buffett Indicator at an all-time record, and the world's central banks quietly exiting dollar assets, that mathematics has a direction. It does not require a trigger to assert itself. It only requires time. Dalio's all-weather framework identifies this stage clearly. It is the stage where cash and short-duration assets outperform long-duration equities, where hard assets, gold, commodities, inflation-linked instruments, historically absorb capital-fleeing paper, where the institutions that moved first sit patiently on their fortress balance sheets while the adjustment happens around them. Berkshire has $373 billion reasons to believe that positioning is correct. The one question I'm going to leave open, because it is the question that determines everything about the severity of what comes next, is this. When Greg Abel finally deploys that $373 billion cash pile, what does he buy? Because the answer to that question will tell you more about the state of the financial system at that moment than any data release, any Fed statement, or any government report ever could. Watch for that deployment. When it comes, and it will come, the window is closing. If you want to be here when that happens, subscribe and turn on notifications, because when this moves, it will move fast. And the distance between understanding this and being caught by it is exactly as wide as the time you spend acting on what you now know.